All right, want to do a really quick recording here. Unless you've been living under a rock, I think you might have heard of what's been going on with Silicon Valley Bank and how that bank has just gone belly up over the weekend. What might happen next, and what retirees ought to be considering, some of the money moves that they might consider making right now, and hopefully deliver a little peace of mind. If you read the headlines right now, or God forbid, if you're on Twitter, you'll see a bunch of 30-year-old quote unquote journalists pontificating about how this run on Silicon Valley Bank reminds them of what happened in 2008 when they were 10 or 15 years old. Of course, all of the fear mongers are out too, claiming that this is the Great Depression revisited and the world's coming to an end. And the most troubling thing about what I'm experiencing right now, from my vantage point, is just how unenlightened some of the headlines coming out of our journalist community are, and some of the quote unquote financial influencers out there, some of the hot takes that they're taking on what's occurring right now. So I want to shine a light on this in a very fact based way. The topic of the Federal Reserve and the Treasury shoring up depositors there is already being called a bailout. It's becoming a political volleyball, getting slammed back and forth at each other. So I want to unpack exactly what happened in a very fact-based way. I'm going to stay out of the realm of politics or what I thought should have happened, and just really stick to what you need to know as retirees and as investors in the environment that we're in right now. Come on. Of course, my computer. Here we go. Um, so here's our very, very important compliance slide. Read every word of that. Nothing in here you should take and run with as pure, full-fledged investment advice. Call our office up, lean into us, talk to one of our planners. We're happy to talk you through your specific situation, okay? All right. First, all of our clients, if you work with us, some of you hire us to deal with the stress surrounding this situation. Some of you don't give a rip about the nation's fractional reserve banking system. You deal with that, Adam. I want to go live abundantly and check items off my bucket list. If you work with us, you're going to be just fine. You're okay. You have little to no exposure to Silicon Valley Bank stock or bonds. The reason I have to write little there is because you might have a sliver of it inside of an ETF, but through the little bit of analysis that I did with some of our largest holdings, we had zero exposure in the funds that I looked at to any of Silicon Valley's bank's equity or bonds. And of course, if you owned their stock or their bonds, you're going to be wiped out entirely. We did a quick audit of all of our banking instruments that we owned. So these are FDIC insured money markets as well as CDs. And we're just auditing to make sure that all of our clients are below FDIC insured limits, which is $250,000 per tax ID. And that has been proven to be true. When we buy CDs for individuals, we make sure that they stay below that $250,000 limit. And even above and beyond that, it appears that the Federal Reserve and the Treasury are making people whole above that for a short period of time here. We took a look at our money markets. Most of our money markets at any point in time have 30 to 40% liquidity cooked into them. So that means 40% of people could come knocking at the door saying, give me all of my money out of this thing, and they wouldn't have to sell a single thing. This is where Silicon Valley Bank went wrong, which we're going to unpack in a second. A lot of our money market instruments are Treasury backed. So is about the gold standard of safety. You have the government's printing press backing up your deposits. And then finally, we use a lot of fixed insurance products, fixed annuities, fixed indexed annuities. I know everyone hates surrender charges. I know everyone hates market value adjustments, but boy, doesn't it feel good to know that you have that safety mechanism when we see the 16th largest bank in the country, the largest bank to falter since Washington Mutual, go belly up. This is why we like these types of instruments, because we know those surrender penalties and market value adjustments are a safety mechanism that protect insurance companies from going belly up when everyone runs for the exit at the same exact time. So if you work with our firm, rest easy. sit back, kick your feet up, and watch the world burn for a few days, because that's exactly what I think is going to happen. This is going to be kind of a short-term thing, where there's going to be a lot of regional banks that we're going to see kind of go up in flames, but will be made whole with some of the safety, um, call them bailouts, call them capital infusions. I don't know really exactly what you want to call them. I don't think it's a bailout per se, like what happened in 2008, but we'll go into that in just a second. What I see when I look at what happened to Silicon Valley Bank, this is a classic run on a bank, like textbook run on a bank. What makes it a little unique is how big the bank was. Like I said, the 16th largest bank in America, the second biggest failure in American banking history. Now, when people see the word Silicon Valley Bank, I think they automatically think like, oh, this just must be like a Silicon Valley thing. And they must have been making loans to highly speculative venture capital firms. And just because they're in bed with Silicon Valley people, they are naturally financially esoteric. And there is a little bit of truth to that. They had a tremendously niche clientele. Venture capital funding is the riskiest of risky investments. And one half of venture capital funded companies in this country banked with Silicon Valley Bank. So talk about a niche clientele. Typically the storyline of how a company goes public is, at first you have some investors who are willing to pour some money in what's called venture capital, and then after that you graduate to private equity, and then after private equity you graduate to a publicly traded business. So this is ground floor investing. Now some of these companies are very big though. A lot of companies through venture capital funding can grow to hundreds if not thousands of employees. So maybe the most troubling or head scratching, but I get it. You know, FDIC insurance thresholds protect us up to $250,000 per tax ID. Only 7% of the deposits with Silicon Valley Bank were insured. So that means 93% of the money that this bank held was above and beyond FDIC insurance thresholds. And that equates to $150 billion. Now, how on earth could that possibly be? Because the average bank usually is about 50-50. So 50% of the deposits at most banks are above FDIC insurance thresholds. And some of you retirees in particular are going, well, these idiots shouldn't have had so much money in the bank. Well, I could just tell you personally, in my little rinky-dink company, I regularly have deposits above and beyond FDIC insurance limits because I need to make payroll. And our company is, 20 people strong. Imagine if your company was 200, 300 people strong and you need to make a payroll nut every 2 weeks of, I don't know, $1 million. This is why they had such a tremendous amount of uninsured deposits and exposure, because most of their clientele were small business venture capital funds or tremendously wealthy Silicon Valley executives. In fact, I saw someone send a tweet that they were really only courting clients with over $2 million or $5 million of loan exposure. So these people were serving a very affluent niche clientele, and that's one, why the bank was so darn big. They had so much money in it, and two, why this is becoming such a disaster. So a lot of people are expecting this to kind of spread like a contagion. I would counter that by saying, how many banks serve this type of clientele? Most banks are serving the mass affluent, as I call them, right? So middle class Americans depositing money into their bank and paying a mortgage off, not with massive payrolls and being funded through venture capital payments. So what went wrong? So if you've been following the market as of late and some of the layoffs, and hopefully none of this is catching you by surprise. If you've watched any of our other videos, you can go back and watch them. Like, this is just the first shoe to drop, in my opinion. Venture capital firms were not cashing checks anymore. They were spending more money than they were taking in via deposits. Most of these venture capital firms are setting money on fire because that's how Silicon Valley plays now. You basically lose and you lose and you lose and you lose until you go viral, until you become a unicorn. And when people are playing fast and loose and it's easy to get your hands on money, these venture capital firms are cashing checks left and right. Well, as of late, they were spending money, withdrawing money quicker than they were taking on deposits and taking on new investment. Couple that with the interest rate risk that was tremendously poorly managed, in my opinion. That's where you'll see some Silicon Valley brass coming out and kind of crying victim. This could have happened to anyone, and I might argue, hey, you guys did a god awful job of managing your balance sheet. They were buying very long-term bonds, right? So to help visualize this, imagine if you bought a 5-year CD 1 year ago, and that 5-year CD was yielding 2%. And now, if you've looked at CD rates as of late, you can get a 5-year CD yielding 4.5%. Well, if you bought the CD 1 year ago, and you said, hey, I want to get out of this, I want to see if someone's willing to buy this off of me. Well, naturally, who wants to buy a 2% CD when you can now buy one for 4.5%? So in order to sell that 2% CD on the open market, you need to take a haircut. You need to take a loss. That CD is what's called underwater. So when you looked at Silicon Valley Bank's balance sheet, they had droves of 10-year bonds yielding 1.6, 1.8%. These bonds were underwater. Now, granted, if you hold the bond to its duration, you're going to get your principal back and no one's going to lose any money. Same thing goes with that CD. So long as you hold the CD to its maturity and not sell it beforehand, you'll be okay. Well, Silicon Valley Bank didn't have that luxury because their clientele were burning through money and taking withdrawals. They had to sell those bonds at losses because their clientele weren't raising capital the way they were in the past. So, in order to shore up their balance sheet, in order to improve their financial standing, they needed to raise money. And in the very same week they were looking to raise money, there was a large cryptocurrency bank called Silvergate Bank that collapsed. The two of them have no affiliation whatsoever. But if you think of cryptocurrency, you think of Silicon Valley. A lot of the individuals in Silicon Valley, not the bank, but the actual area, the geographic area, are early adopters of cryptocurrency technologies and cryptocurrency projects. So here you've got a bank that served this area and it needs to raise money, and one of their banks down the street for them or in the same echo chamber goes belly up. So the next thing they do is they send a letter to their investors, which was terribly written. If someone in my office wrote a letter like this to investors, they would lose their job. But they wrote a letter to the investors that sounded desperate, saying, hey, guys, we need a little money to improve our balance sheet. And then finally, the straw that broke the camel's back, Peter Thiel, who's one of the most successful venture capital investors on the face of the earth, he runs a fund called the Founders Fund. He went around to all of his companies within his Founders Fund and said, hey, guys, I think you should get your money out of Silicon Valley Bank. They're against the ropes. They're asking for money from investors, and they got a really bad bond portfolio, everything that I just listed above. And naturally, when Peter Thiel speaks, a lot of people in Silicon Valley listen. So people started taking their money out of the bank. And then one friend spoke to another friend. And Silicon Valley is kind of a small little group of a small little echo chamber that everyone talks to each other and jumps on Twitter and looks at each other through their nostrils and pontificates together. So naturally, everyone ran to the bank to withdraw their money. Silicon Valley Bank needs to sell their bonds at losses. And next thing you know, the bank goes belly up. This is not 2008. 2008 was a very different set of circumstances. 2008 were investment banks leveraging money up 30, 40, 50 to 1 using exotic financial instruments that went belly up, mainly mortgage-backed securities and credit default swaps and credit default obligations. And we won't even take you down that path. But this is a classic run on a bank. A classic run on a bank. This is not a highly leveraged financial instrument that all of the big investment banks own that are going to go south and sour really quickly. But that's what went wrong. Nothing more, nothing less. A classical run on the banks. Now, what's next? Because some people are saying, well, Silicon Valley Bank is the tip of the iceberg, which could be true because if you look at the American banking system right now, that bond issue that I just shined a light on, banks right now are sitting on $620 billion of unrealized losses, meaning their bonds, because interest rates went up so quickly, are underwater. So if every single one of you were to run to the bank and say, give me all my money, not everyone just on this webinar, but like everyone throughout the whole world, well, all of these banks would have to sell their bonds at a loss. Now, hopefully banks did a better job of managing interest rate risk and liquidity than Silicon Valley Bank did, because most banks should keep large swaths of liquidity so they could satisfy numbers of people coming to the door saying, hey, give me my money out. So there is an element of, hey, this could be a tip of the iceberg. A lot of banks are sitting on unrealized losses. Now, look at the word unrealized. Unrealized means we're only going to realize these losses if we sell our bonds. If we hold them to their maturity, and hopefully that maturity is short in duration, we aren't going to lose a penny. Everyone's going to be just fine. I don't think this is going to spread like a contagion. Now, I think in the short term, we're already starting to see some banks. Signature Bank went belly up. In the news right now, First Republic Bank is, the stock price is down. We're seeing, the shrapnel kind of spread in the regional bank sector, but none of these banks were quite like Silicon Valley Bank. That niche clientele they had is going to be is their downfall, in my opinion. When you only serve a small segment of society and they're all pulling money out, none of them are putting money in. Couple that with the unrealized losses in their bond portfolio. That's why they're facing the repercussions that they're facing right now. The other thing I see getting thrown around is they're calling it a bailout, what the Federal Reserve did and what the Treasury did. And of course, the Federal Reserve came out and said, created something called the Bank Term Funding Program, where they're basically going to be giving people 1-year interest-free loans on any of their treasuries or any of their mortgage obligation bonds. So this should be a great lifeline for the banks that do have a number of their customers knocking on the door saying, hey, give me all of my money. Now, where are you going to put that money? We'll talk about it in a second, but I don't think that's the wisest idea to begin with. But naturally, people are going to do that. That's what, calamity breeds more calamity. So the Federal Reserve has initiated this program where they're basically to give people free loans, and then the Treasury has come out and they're going to provide about $25 billion in credit protection. So that's basically the Federal Reserve infusing the plumbing of the system with more capital. Now, here's why it's not a bailout. If you owned Silicon Valley Bank stock or you lent them money through bonds, well, you have nothing to show for it. You went belly up. You lost it all. This is in the FDIC and the Fed and the Treasury coming out, they're making depositors whole. Now, I know all the way over here in South Carolina, and maybe you've got a different worldview than someone in Silicon Valley, you might go, hey, I want to see the world burn. They should have, crashed and fell on their face. It's their fault. And I would just argue that, if you're just an employee at a venture capital firm, is it your responsibility to make sure that your employer is banking with a institution that's managing their bond portfolio properly? Heck, even if you're a venture capital founder, Is it your responsibility to actively audit the liquidity position of your banking institution? No. It'd be impossible to do that. Heck, even the Wall Street analysts, I posted something on Facebook the other day, like consensus on Silicon Valley Bank was strong buy, undervalued, stocks going to $330 a share. And these are quote unquote like financial gurus analyzing this company's balance sheet. So the victims of this bank failure are everyday employable people. Now, every day in that they work in Silicon Valley, they probably make a lot more money than the median income here in this country. So it's easy to kind of, hey, let's eat the rich. But I do think that depositors should be made whole here. But by making depositors whole, you're essentially incentivizing bad behavior. If people don't get injured when they do risky bad things, it breeds an environment where more people will take excessive risk and do bad things. So I can kind of see both sides of the coin here. You'll hear a lot of people saying these people should be out in the cold, they should lose their money. If you work at a Silicon Valley startup, you should be fired because your company can't make payroll. And honestly, what if the tides were turned and the next bank failure was for, I'm not even going to say a name out there, but your employer. So some of these people are getting penalized in a tremendous way through no fault of their own. Now, it's not a bailout like what we did with Lehman Brothers. Lehman Brothers, of course, didn't get bailed out, but AIG and all the big investment banks during 2008, as those companies took excessive risk, and their shareholders, their leadership, were in essence rewarded with free loans and free money, whereas some of those companies probably should have went bankrupt. In this case, we're making depositors whole. So call that what you want. I don't think it's a bailout per se. I think it's acting as a backstop. I do agree, though, by acting as a backstop, you are, in essence, rewarding bad behavior. And rewarding bad behavior, in essence, is punishment to all of the suckers like me out there who play really tight to the vest with their money and don't like to take excessive amounts of risk. That seems to be a trend here going on in this country, which grinds a lot of people's gears. So, what should you do as investors? Well, one, the most lowest hanging fruit and the most simplistic thing to do is make sure your bank holdings are below FDIC insured limits. Now, FDIC insured limits is $250,000 per tax ID. So if you're husband and wife, that's $500,000 per bank. Now, if you've got a irrevocable trust, that trust probably has its own tax ID number. That adds another $250,000 limit. If it's a regular old like pour through trust, a revocable trust, that revocable trust shares your tax ID number. That does not add another $250,000 limit there. So just make sure your CDs, your bank savings are below that FDIC insured limit. Number two, prepare for volatility and a lot of noise. I led this thing off. I had a conversation with Chris earlier where I said, what the most disappointing thing is our quote unquote financial gurus out there like are being exposed like the emperor with no clothes on. They're not that bright. Like they use long esoteric words, but they're pretty wet behind the ears to a certain degree as it relates to bearing witness to bank runs. Like I said, a 30-year-old journalist pretending this reminds them of 2008 when they were 10 or 15 years old. So there's going to be a lot of noise. There's going to be a lot of people saying the bank runs are spreading like a contagion, and Silicon Valley Bank was the tip of the iceberg. There's going to be a lot of people saying the government bailed out bad actors. There's going to be people saying that the entire, you know, reserve banking system is going to go belly up, and you need to put all your money in gold. So, be a wonderful time right now to kind of put the blinders on and hit the golf course or go for a long walk on the beach, and don't watch too much financial talking head news or read too much into these newsletter salespeople, because there's going to be a ton of noise, and we do anticipate the market to be a little choppy. Saw it was down at the open today, down over 1%, and of course it sprung right back up. I'd imagine, the saying is don't fight the Fed. If the Federal Reserve keeps coming to the table with more money, that's typically a bullish sign when the Fed is basically opening up their coffers. Would not be surprised if we see Jerome Powell begin lowering interest rates. That, of course, would be relief to the regional banks, too, who have these unrealized losses in their bond portfolios. Hey, I'm going to say something that sounds like advice your grandmother would give you. I know Claire is going to be applauding this right now. She's a big cash on hand girl. Might not be a bad idea to keep a little cash on hand. Cash on hand doesn't sound like very sophisticated financial advice, but if anyone lived through 9/11 when all the banks closed down, might not be a bad idea to have a couple $1,000s cash on hand on the off chance you're doing business with a regional bank and you go to the regional bank and it's surrounded by FDIC security guards. So keep some cash on hand. Keep your deposits below FDIC insured limits, because look what's happening to Silicon Valley investors right now. They're all being made whole Monday. Literally, the bank goes belly up Friday. On Monday, they're all being made whole. So what I'd anticipate with the plumbing infusion of capital that Treasury and the Federal Reserve has infused, even if your bank did go belly up, you're going to be made whole. But still, not a bad idea to have a little cash on hand to get you through a short period of time of needing to get your hands on some money. Sounds like crazy financial advice coming from a financial person, but cash on hand is still a tried and true thing that I think everyone should have. Now, what's cash on hand? 5 grand, maybe max. You start getting over $5,000, like there is an inherent risk that comes with that as well. You could be robbed and have no recourse. You can, I don't know what else could, a fire, a flood, or God knows what else. You lose that money. You can't exactly go to the bank and say, "Hey, I had cash on hand and I squandered the money somehow." And then finally, and maybe most important, we led this off to our clients saying, "Rest easy. Rest easy. Your portfolio was built for this. If you've got if your portfolio is designed properly, you should have stores of stability and liquidity and safety cooked into your overall plan. Your plan, if you have these mechanisms in place, was built for this type of environment." And I also want you to take a 10,000-foot view of the overall market. Do you think because there was a run on a boutique Silicon Valley bank on the other side of the country, if that's where you're watching this from, do you think people are going to cease to, um, you know, want to buy new automobiles, and businesses aren't going to need widgets, and commerce is going to end as we know it because this bank went belly up? This is not the first bank that has defaulted and gone belly up. It will not be the last. In fact, we'll probably see a few more in the coming months because of that interest rate risk and the poor management of it. Um, but if you're working with us, lean into my firm. Let's go over your portfolio. Let's go over your plan. Know that we've got our watchful eye on this. We're making sure our deposits are below those FDIC insured limits. We're auditing our money markets. We're making sure we're not overly exposed to what we're seeing out at Silicon Valley Bank right now. Thank you so much for tuning in. Feel free to reach out, schedule some time to talk with us or email with us. We can talk you through what you own, why you own it, and why we feel you should be able to rest easy, even with an unprecedented bank failure that we just witnessed.